As we talk about markets, they have been witnessing a sharp gyration since the June month. And if your active funds have consistently been underperforming, should you stay invested or not? That's the question we are asking our expert today, and we'll get on board Mr. Aditya Shah of JST Investments in minutes from now to understand how to manage the active funds in your portfolio and which ones should you stay put. But before we go to our guest, we begin the conversation. Let's take a step back and look into what are the active and passive funds to give a perspective to our viewers. Firstly, let's talk about the active funds. So these are those funds which are being actively managed by the fund managers, and what they try to do is they try to outperform the return in terms of returns to the benchmark indices. It can be Nifty as well as the other index as well. But on the other hand, the passive funds are one that those are also managed by the fund houses, but they just try to meet or match the performance of the index, but not to beat. That's not the criteria. When it comes to the active funds, so the fund manager decides on which types of stocks and the quantity of the stocks they want to enter into depending on the fund. But the fund manager in the passive fund will invest your money just into the stocks which are lying in the index that has been selected. For the active fund, the consumer is going to be paying a higher fees when it comes to the transaction cost as well as the cost of managing the fund. But on the other hand, the passive fund, because it's just a replication of the index, can give you the benefit of a very low on fees terms. The active funds are a bit more flexible in terms of which stocks to use, but the passive funds are not, and the active funds don't have much clarity on which components they're going to be including into their fund, because that's something that is not very great about. But passive funds have more transparency in those terms. So that was just to give a perspective. But recently what we are witnessing is that the active funds have been consistently been underperforming, because of course the markets have been quite very volatile, and what the active fund managers are finding problem is to generate alpha from the short to medium term durations, because you are aware when it comes to Nifty only, we are just like almost flat on a YTD basis. But although one can beat for the long term, because India as a market, like unlike the international, is still holding up to its gains in terms of green, but a lot goes into the fund manager strategy, right? Which is why we are getting Aditya to guide us in a better way what to do with your current and ongoing active funds, as well as what are the factors that you should be looking up to. Very good evening, Aditya, and thank you so much for joining on ET Now. Firstly, please tell us the funds that have actually failed to deliver more than the benchmark amidst this volatility we were just talking about. And after all, it's during these times that the fund manager expertise is expected. So which are the funds that have managed to outperform?
Good evening, ma'am. We have seen that over the last 1 year, big names such as Parag Parekh have started to underperform the index. The AUM on these funds have grown drastically over the last 3 to 5 years because of the outperformance. Now they have started to underperform. Also, as you have correctly pointed out, that from the the month of June, there has been a lot of volatility inside the market. And the third point is a lot of US markets have also corrected when a lot of these funds used to always invest in as well. So what you should do is, over the period of 3 years or 3 months or 1 year is a very short duration of time to judge any fund manager's performance. Every fund manager out there will go through periods of outperformance as well as underperformance. During periods of outperformance, you should during periods of underperformance, when the mutual fund is not beating the target or not beating the benchmark, what you should really do is you should evaluate the fund manager's strategy, B, the Sharp ratio, which gives you the risk-adjusted return that the fund manager is really taking. Third point is, don't be in a hurry to redeem very fast. Look at the returns over a period of 3 to 5 years. If the returns are good over a period of 3 to 5 years, it means that the fund manager is performing. For a short period of time, the fund manager can underperform. Let me take the example of Parag Parekh Flexi Cap Fund, which has done phenomenally well over the last 3 to 5 years, but this year has spectacularly underperformed the whole Flexi Cap category as well as the benchmark. So what has happened is, the reason of outperformance was their investments in the US markets. And the US markets have started to tremendously underperform this year. That's the first point. And the second point is they have tried to stay true to their value picks. For example, if everybody is moving to ICICI Bank, they have stayed true to their value investment story and tried to stick to an HDFC Limited, which has spectacularly underperformed this year. So my opinion would be short-term underperformance should not be the basis of long-term investment decisions. Every year, we should not be chasing the best performing stocks. SIP, one good fund, at least for the next 5, 7, 10 years, and you will see a good fund manager delivering superior returns. On the fund which are not performing, look at the portfolio of the mutual fund, look at the experience of the fund manager, look at metrics like the Shah ratio, and then decide. And if you're not able to decide on all of these things, as you correctly pointed out, index funds would be a better option than an active fund.
Okay, so that's the strategy when it comes to like picking up which fund you want to be. How's your active fund performing? Just don't track into the short term. The longer term perspective is what you should be looking at. But Aditya, the fund manager plays quite a tricky role when it comes to especially in the small and the mid cap categories. What's a red flag in terms of the portfolio construction that an investor should look? After all, when it comes to tracking or planning and exit any of the funds in that category, that's quite a crucial point.
Definitely, ma'am. So first of all, let me give a disclaimer. The mid cap and the small cap funds are only for the highly risky individuals who can tolerate risk in the market. On the fund manager side of it, if the fund manager is trying to invest in 100, 120, 150 stocks, it is a no-no. There are not so many stocks that are available that are investment worthy. That's the first one. The second point is in the small cap category, we have seen somebody like a quad small cap fund delivering spectacular return over the last 1 year. The AUM there has grown from about 1,000 crores to about 10,000 crores. What we have seen and what we have noticed in the portfolio of quads small cap is that the fund manager is not remaining invested in any of the stocks for more than 6 or 12 months. If the fund manager is not investing for the long term and trading in the market, that kind of a strategy can work in a small AUM or can work when the market is in a bull market. When the market starts to turn volatile or the fund manager has got large amounts of AUM, such strategies will be very, very difficult to get returns from. So my point is, look at the fund manager, look at the strategies that he's following. If he's following the strategy consistently and not changing his strategy with the market returns, then he's a good fund manager. The second point is, if he's including any stocks anywhere between 100 to 150, for example, a Nippon small cap has got more than 100 stocks, it is a red flag because there are not so many small cap stocks that are investing. The third point is small caps are extremely volatile. During down phases, you will see a lot of drawdown in these funds. So what you have to go ahead and see during 2018, 2020, what were the drawdowns that these funds were facing. Then it will give you a broad example of how the quality of the fund, quality of the scheme is, and from there on, you need to take a look.
Okay, so those are the points when it comes to tracking your active funds when it comes to the mid cap and the small cap category. But Aditya, in this volatile markets, I'm sure there must be some funds that must be outperforming the benchmark indices. You mentioned Parag Parikh fund because they had this strategy where for now they could not be in a position to like beat the markets, but they are onto their strategy, and their strategy is somewhat different into the value investing. But some of those funds are really outperforming in a good way into the markets. So now is the time to because what the general trend suggests is that investors get into those funds which have seen good growth over the years, maybe in the past 1 or 3 years. So what should be the strategy of the investors? Can historical returns tell you that going forward as well, the return expectation could be on the higher side?
And historical returns are one of the parameters to evaluate a fund passing for investment or not. There are several other parameters that you need to look for. The other parameters include the quality of the fund manager. This is a very, very quantitative factor that you need to monitor. For example, as I talked about Parag Parikh, the fund manager there is extremely good, and that's why my confidence on Parag Parikh is there. I have been seeing them ever since their launch in 2016. There are some funds that have delivered spectacular returns, like the whole of quant pack has performed spectacularly, but all the funds do not show any investment strategy. After the historical return, the second point that you need to check is what is the investment strategy that the fund manager has exhibited over the last 3, 5, 7 years? Is there any track record of the investment strategy or not? The third point is you need to track the track ratios such as Sharp ratio. What is the Sharp ratio? It is risk-adjusted return that a mutual fund can give. A large cap fund will have a higher Sharp ratio because they take very less risk in the market, and therefore the returns are also lower. While a small cap fund will exhibit higher returns, but the risk that they are taking will also be higher in the market. So these are the 3 or 4 funds that you need to things that you need to check. And of course, the portfolio of the mutual fund is also very important. If a normal retail investor cannot afford to do this kind of an analysis, there are 2 options available. One of the options is go to an advisor who will advise you on which funds to invest in, or you can then straight away go to an index fund or a passive fund where such kind of an analysis is not required.
Okay. So that's the word coming in when we all discuss about the active funds, especially, which are the points that you should be looking at and how to look at the strategies and what factors to consider. That was the discussion all about. But Aditya, now moving on, and it's time to get some of our viewer queries. And we have got the query today from Ravi Ahuja. He says that he's 33 right now and he wished to garner 1 crores for his retirement by 2040. He has also shared that some of the SIPs that he started in August 2021, and that's an SBI small cap fund, that's 1500 per month, DSB equity opportunities 1500, and UTI flexi cap fund 1500 is what he's investing currently. That's sums up to around 4500. But Aditya, what's your suggestion to him? How to garner 1 crores by 2040, because I'm assuming that by 51 he wants to retire. I wish I had this dream, but what's the suggestion for him?
First of all, the investor is invested in regular plans, so he needs to check out who his mutual fund distributor is and discuss with him about his goals. The second point is that he's investing 4,500 SIP for about 18 or 19 years. So that will yield about 40 lakh rupees if I expect a 10 to 12% return, which is way short of the 1 CR goal that the investor really had. Therefore, there are 2 options available with the investor. A, you increase your SIP. If you don't have any more money to spare, try to increase your SIP by 10% every year. Or the second thing that you can do is increase your time horizon, push your retirement goals by this 5 to 7 years. That's the second part of it. As per the funds that the investor should invest in SBI small cap, Parag flexi cap, and UPI Nifty Next 50. It is a mixture of active and passive fund, and there's a small cap fund also, since the time horizon of investment for the investor is long term. Consistently and in a very disciplined way, if the investor continues to invest in all of these funds, he may reach his goal, provided he does the 2 things that I said: either increase the SIP or elongate your time horizon so that the power of compounding can be really taken into account.
Okay, so that's the answer for our first query, but next query is from Hiren Dholakia, and he's from Ahmedabad, Gujarat. He says that he's 37 right now and he wished to start investing for children education, and maybe in the next 5 years he will be needing the money. He also plans to purchase a house after 10 years, and retirement planning is for after 23 years is what he wants to start with. Currently he has some of those SIPs going on, like not exactly some of those. He has around 6 SIPs going on. He's also been investing in NPS by HDFC, and in all of them he's been investing 2,000 rupees per month. Aditya, what's your suggestion, because he has quite many goals to get this money ready for, and how much this will sum up, and what's the suggestion for him?
And first of all, the amount of money that he's investing, he will be able to reach his only goal of retirement. All other goals are not possible with the amount of savings that he is doing. So again, the same thing, either push back your goals, either cut down on your goals of children's marriage, or try to save more, or try to elongate the time horizon of these goals. The second point that I have noticed in the investor's portfolio is that investor has got sectoral funds inside his portfolio. Sectoral funds are something that the retail investor should never invest in because they require timely entry and timely exit. So say a no to the sectoral funds. Now you must recalibrate your portfolio into these four funds: Parakmanik Flexi Cap Fund, Axis Small Cap Fund, Mirai Asset Tax Saver Fund, and UTI Nifty Next 50 Fund. If you are able to invest into all of these funds for about 10 to 15 years or even longer, maybe you will be able to reach first one of your goals. For the other goals, you need to think through the process and save more so that you have more money for compounding.
Okay, so that's the suggestion coming in from Mr. Hiren Dhulakia. I hope he gets the answer and follow the same. But for this, we'll let you go on that. Thank you so much, Aditya, for joining us today for this such interesting conversation and helping our viewers with the take when it comes to the active funds.